Good afternoon and welcome to this week's BizSmart Lunch and Learn Webinar. Our weekly webinars are aimed to provide advice and share knowledge on key business topics and specialist areas. And our host today is BizSmart Select Member and Core Advisor Ian Priest from Independent Banking Consultants. And he is here today to talk to us about banks' lending system and how they get it wrong. Before we start the webinar, can I ask you all to use the question mark function on the screen to post any questions that you may have for Ian, and he will do his best to answer them all at the end of the session. Thank you, Ian. Over to you.
Thank you. Although this presentation is titled The Broken Banks, it's not intended to be a bank slagging off session. I'd rather just give you an insight into what's happening within banks, what's slightly gone wrong, and what you can do to help yourselves when dealing with banks. As part of the process, we'll highlight some of the challenges for commercial borrowers and give you an insight into the convoluted way that banks make their lending decisions. I'm going to quickly tell you a little bit about independent banking consultants, the things that have gone wrong, a quick look at the intermediary market and its pitfalls, what's going on with banks at the moment, then how they actually lend money, the information they look at and the process, the flaws in the system and how you can get past them. So independent banking consultants, established in June 2000, we're all experienced and fully qualified lenders, individually over 36 years experience each. We arrange finance and advise on banking and business issues. We've raised over £280 million for our clients to date, and we are authorised and regulated by the Financial Conduct Authority. So it's not just mis-selling, there are structural issues with all of the banks, and since about 1985 the emphasis has been on sales rather than professional banking. Staff, as I'm sure you've all experienced, were browbeaten by sales targets and management by numbers. And to be fair, the mis-selling that went on was more about fear of the sack than generating huge bonuses. 30 years of training staff in sales, not banking, has left an enormous skills gap and knowledge gap in the banks, which unfortunately small businesses bear the brunt of. And this lack of knowledge and skills is having a detrimental effect on many small businesses. The intermediary market. So where do borrowers go for help? They go to accountants and business advisors or consultants, but neither of them are actually specialists in dealing with banks. I wouldn't dream of telling my accountant how to prepare my accounts or how to set them out properly for the tax man or even how to minimise my tax bill. That's for him to tell me. Likewise, as a banking specialist, I would expect the accountant to ask me how to present a case to banks. It is very different from writing a business plan. Finance brokers. There are a lot of finance brokers out there. They throw up their own issues, more of which to come. So finance brokers. The first is a big health warning. Commercial finance is still largely unregulated. It's only been in the last 2 years that the Financial Conduct Authority have really taken an interest since they took over the Consumer Credit Act regulations. The Financial Conduct Authority have, quite rightly in my opinion, reinterpreted the rules around the Consumer Credit Act and have applied it now to sole traders and small partnerships. Limited companies, however, at the moment are still exempt. Because of the lack of regulation, there are many unqualified and inexperienced operators in the business broking market, and the quality of advice that they give varies widely from the awful to the just plain bad. They very often have a one-size-fits-all approach. I know brokers that think invoice finance is the answer to every problem. It isn't. It's a great product in the right circumstances for the right customers. It's an awful product in the wrong circumstances or for the wrong customers. It should only be used with caution. There are many conflicts of interest, as many brokers are commission driven and they follow the fee, which means they go to who is going to pay them the most or which is easiest and they get paid the quickest, not necessarily concerned about where they get the best deal for the client. So the present lending climate. The era of cheap money is over. Well, I've been telling people for the last 7-8 years that the era of cheap money had gone and it wasn't coming back. You know what? I'm starting to change my mind. Yes, there was an abnormal market due to the credit crunch, but actually I'd argue it was an abnormal market beforehand. Banks were throwing money out the door as fast as they could and were competing on price to get volume. It was looking back, it was a lunatic situation and one we should never let happen again. Give it 5 years, maybe 10, depends. They have short memories. So the market hit a brick wall. Many lenders stopped lending completely. I was managing partner at Clydesdale Bank and was placed in the hideous situation of having to phone clients up and tell them that £26 million of borrowing that had all been agreed and was waiting for them to draw down was no longer available and they couldn't have it. We literally just stopped. Money's been in much shorter supply since the crunch, so banks felt they no longer had to compete as strongly for borrowers. They could be much more selective about who they were going to lend to. Prices generally rose across the board, and lending terms became much, much tighter. As I said, not all of that is a bad thing. It protects businesses in the long run from borrowing too much. Having said that, I've just jumped on a slide. I am starting to see lenders compete on price, and I've just got a deal away for a client at 1 3/4 over base, which was a margin I never thought we'd see again in the foreseeable future. So how do banks lend money? Many of them use a basic analysis model called Campari, which, as you'll see from the screen, is an acronym made up of character, ability, margin, purpose, amount, repayment, and insurance. It doesn't actually mean insurance, it means security. What is the bank's insurance about getting repaid? So, if you're presenting a case to the bank, these are the areas that you need to cover off in the documents that you propose to them. Character. They want to know that you're trustworthy, that your credit check is going to be clean. If there is a blemish on your credit record, don't try to hide it. They'll find it. It will show up. Explain what and why it happened and why it's not going to happen again. Money laundering. All the banks have to go through stringent money laundering requirements, and I know it sounds sometimes like they're being incredibly petty when they want all sorts of documents from you just to prove you are who you are, particularly if you've been a customer of the bank for donkey's years. The sad thing is that historically their records weren't very accurate, and they now are having to run hard to catch up on making sure they've identified customers to stop the criminals and the drug lords laundering their money. Track record, if you're an existing customer, particularly if it's a good track record, then you need to stress that. Ability. I know we're supposed to not be an ageist society anymore, but they will consider age and health if that is appropriate to what it is your business does. They will look at your business acumen. They will want to know about your skills and qualifications and your ability to actually do what it is that you do and your experience in running a business. Your ability to do what you do and your experience in running a business could be two very different things. They will want to look at the quality of your management team, and that between you cover a whole range of disciplines. If it's not in-house, that you've got that support from your accountant, your lawyer, a business advisor, that there is more to the business than just you ploughing your own furrow. And they will look at your trading history, how long you've been trading, what sort of track record you've got. Margin. This is where the bank is looking at how much it's going to make out of lending to money to you. Are they getting the right return for the risk that they're taking? And their return will be made up of interest, fees and charges. Their return should reflect the risk that they're taking. It doesn't always, and as I said, I've just seen a deal at 1 3/4. That's a great deal for the client. Actually, the bank's losing money on that when you take into account the amount of capital they have to put aside for it. So the return clearly doesn't reflect the risk because they're losing money. It's mad. Nobody would expect a normal business to stand on the corner and give money away, and actually that's what this lender's doing. Purpose. What do you want the money for? Is it legal? Is it moral? Within banks' lending policy for that sector, all banks have lending policies for various sectors, and sometimes you just do come up against a brick wall. It's not the bank's policy. There are several banks at the moment, for example, that even for really good customers, they won't look at a property deal. I've sent a deal out yesterday for a £300,000 loan to buy a property for holiday lets. The customer keeps £160,000 in his bank current account, and his own bank said, no, we're not looking at this, it's property. Yeah, great, they're going to lose a really good customer. They want to understand that there is a need for the finance and that the term of the facility is in line with the stated reason. So if it's property, 15, maybe 20, 25 years, a van, 3, possibly 5, you wouldn't want to do a van over 20 years. The amount. It sounds stupid saying they take the amount into concern. But they have to make sure that they're not lending you too much, more than you can afford to repay, but they should also be checking they're not lending you too little. For example, it's no good lending you the money to buy a new factory, a new warehouse, if you then haven't got enough working capital for the business to operate once it's in that new premises. So they should be looking at the bigger picture and taking into account the cash requirements of the business, not just the amount you've requested for the loan. I've just done a deal for a client where they were spending nearly £1 million on a new factory. That was the brief they gave me, to get them £1 million for the new factory. They hadn't even thought that by taking on an extra £2.5 million worth of work a year that was going to go into this new factory, they'd need more working capital. So actually the proposal we put out to lenders was for nearer 3 million by the time we'd worked through everything that they needed. What's the borrower's cash stake? There is absolutely no point going along to the bank and asking them to lend you 100% of what you need. They want to see that you have put something into the business yourself. If it's not cash, that it's time and energy, but ideally they want to see some commitment from you into the transaction. Otherwise, what's to stop you borrowing the money, getting bored and walking away? They really want something to lock you in there. They call it hurt money. Repayment. The source of repayment should be the paramount concern to any lender. How are they going to get their money back? Is it going to be from the cash, from the profits that you generate from the business, or is it reliant on selling assets? So if you're moving to a bigger factory, are you able to sell the existing one, or are you able to get out of the existing lease? Generally, repayment would be from profits, but I say that with caution because profit doesn't necessarily translate into cash. I had a client a couple of years ago who told me he could afford to pay £5 million for a new factory and pay it off in 7 years because he was making £1.5 million profit a year. He was making £1.5 million profit a year, but he couldn't afford the new factory. And he didn't understand when I said to him, you can't afford to buy this new factory. The problem was he was making £1.5 million in profit, but his debtors and his stock had increased by £3 million, and his creditors, his supplier credit, had only increased by £1 million. So his £1.5 million profit didn't make up the difference between the increase in debtors and stock and what he could get from his creditors. In fact, £500,000 of cash had gone out of the business in the previous 12 months. And if he carried on in that vein with a new warehouse with more storage and got more stock and more debtors, he would run out of cash very quickly. They will want to look at your profit and cash flow forecasts, and they will sanity check them against your historic financials. So there's no point in putting in a set of forecasts that shows your business is going to quadruple and you'll be a millionaire by Christmas if the trend in your existing accounts doesn't back that up. They have to be sanity checked. You have to have a logical progression from your existing accounts into your forecasts. If there's a large difference on something, explain why. It might be you've got a brand new product that you've spent years developing and therefore you've had lots of costs and the sales are only just starting to happen. That's great, but explain it. Don't assume the bank will work it out for themselves. The other key thing is what reserves are there in the background. What worth has the business got? Because that's going to be the first fallback position for the bank if something goes wrong. Insurance or security. What is the alternative repayment source for the bank if something goes wrong? There's lots of different ways that banks can have security. The best is cash, but then if you've got cash, why would you be borrowing? See, strangely, some people do. The second best typically is bricks and mortar. In fact, cash and bricks and mortar are the only items of security the bank are allowed to consider when they work out how much capital they have to put into a deal. There are other forms of security. There are personal guarantees. That's a promise from you to repay the bank if the company doesn't. A lot of people often say they're prepared to give a personal guarantee, but they wouldn't give a second charge on their house. Well, guess what? Personal guarantee is a second charge on your house. The bank just hasn't registered the second charge yet. If you default on a guarantee, the bank can take that along and get a charging order placed against your house. So please bear that in mind. If you sign a personal guarantee, it is almost as good as giving them a second charge over your property. For limited companies, the bank can take a debenture. That is a charge over all the assets of the company. So that includes the cash, the stock, the money that is owed to the company by your customers, and any IP or any trademarks or designs that you own. Having said all that, security is not the deciding factor. Banks typically are not pawnbrokers. They're not looking at the value of your security and saying, I'll lend you £10 against that. They should be making a reasoned decision based on all of the other things that we've looked at, and security is their backup if things go wrong. So, how do banks lend money? Typically, the process starts with a meeting with the manager to discuss the proposal. Unfortunately, for a lot of small businesses, that's now done over the telephone and you never actually get to meet an account manager. In fact, sometimes it's almost impossible to speak to the same manager more than once. It's a dreadful state of affairs as far as I'm concerned, but all the banks seem to be moving that way because it's cheaper and they think more efficient. They've tried it before, it's failed. Unless there's been a huge change in the technology that will make it work this time, I'm wait to be convinced. You will provide some information and answer the bank's questions, and the manager writes a report. Sometimes they write the report. Sometimes it sits on the too difficult pile because they haven't got enough time to deal with it, or they don't understand it, or they just don't have enough knowledge to put it together. And you can be weeks down the line thinking your bank's dealing with it, and actually it's just sat there because the manager doesn't know what to do with it. Assuming he's written his report, he sends it to an underwriter. Very few bank managers these days have the authority to make lending decisions on their own. It nearly always has to go to an underwriter. The manager and the underwriter have a discussion, and then the manager comes back and advises the borrower of the outcome. So where are the flaws in that process? It's inconsistent and flawed. It doesn't work. It's too reliant on one manager, and as I've already said, he could have a huge workload, he could be lacking experience, she could be lacking in experience or knowledge. They may not have dealt with your sector before. It may just be a confusing proposal that they haven't got the time to sort out. There are three types of bank managers. There are some very, very good ones, there are some not very good ones, and unfortunately there's an awful lot of lazy ones. And the one thing they've all got in common is they don't have enough time. They're all under immense time pressure. So if it's a sector they don't know, if it's confusing, if the information's messy or got gaps in it, they haven't got the time to sort it out. So they will just say no. The use of written reports has many shortcomings, not least that the customer never sees it. The bank manager's had a conversation with you. They may have had a look around at your premises if they've come out to see you. But it's even worse if it's over the phone because they can only get what they've gleaned from that phone call, and they might have got hold of the wrong end of the stick completely. If they've got hold of the wrong end of the stick when they're talking to you, then their written report is not going to make much sense. I had a case last December where a banker came to me and said, "Can you help? I've promised this customer we'll be able to do it. I've submitted to credit and they've declined it, and he's already exchanged contracts. I feel awful. I'll send you my report to help you help this client quicker." I read this report and thought, well, I'm not surprised it's been declined. It doesn't make sense. I went out to meet the client anyway, and within about 2 minutes, it was apparent that this report was complete garbage. The banker got hold of the wrong end of the stick completely. The report he'd written was a complete nonsense. It didn't make any sense, and it was no surprise it had been declined. Actually, the project was very sensible. It worked perfectly well, and I got two lenders fighting over it, and we did actually get him the money in time to complete by the end of January, so he didn't forfeit his deposit. Coming back to the flaws, an underwriter is the ultimate decision maker. This is a little tin god in his ivory tower that you'll never get to speak to, and who can make all sorts of irrational decisions. The next point says poor relations with underwriters can create problems. I have seen instances where a perfectly good proposal has been turned down because the underwriter didn't like, didn't trust, did not believe the account manager. If it had come from another account manager, he'd signed it off perfectly happily. But because it came from this particular account manager, there was no way it was going to get approved. Now, that's not your problem as a customer unless you're on the wrong end of that, in which case it can be a huge problem and there's absolutely nothing you can do about it. And no, borrowers can't deal direct with the underwriter. They won't talk to you. Even if you turn up in their office, they will refuse to speak to you. They always want to deal at arm's length through an account manager. Archaic, yes, but that's the way it is. Flaws in the systems. Problems with other borrowers can affect an underwriter's decisions. You might have a perfectly good case, but the account manager you're dealing with might have several problem customers, and if all that underwriter's been seeing from him is stuff with the problem customers, they start to treat everything that comes in from him as a problem customer. So they start looking for problems in your proposal that might not be there, but they'll go looking for them. So the whole process is conducted behind closed doors and cluttered with bear pits that it can fall into that you have no control over. And as I said earlier, you as the borrower never know just how your case was presented. It may have been brilliantly presented. On the other hand, it may not have been. And these factors will combine to influence the outcome, not just whether it's approved or declined, but the terms and conditions that are attached to that decision. So you might actually end up paying more because the underwriter doesn't trust your account manager, or you'll have worse covenants and conditions that you have to comply with because the bank doesn't trust that account manager. Yes, I know it's bonkers, but that's what we have to deal with. Borrowers just do not have enough control or influence over the lending decision. So, how can you get more control and influence? This is how we do it. We work on the basis that the best person to negotiate with a lender is another lender. It's remarkable how quick and easy conversations turn out when I'm sat with a client and they're talking to a lender. And strangely, they don't try to sell them things they don't want and don't need either. We know how they think. We speak their language because we did their job for a lot of years. We know what buttons to push. We know what influences them. We will actually write the lending proposal for the bank to use. So we don't just influence the content, we dictate the content, we write it. We get our clients to sanity check it to make sure we haven't missed anything or gone off at a tangent, or we do all the risk analysis. So we make it very, very easy for a banker to sit down over a cup of coffee and realise that this is a deal they can do. And once they realise it's a deal they can do and they want it, then we can get them to compete with each other to win the business, and that's how my clients end up with nice interest rates like 1 3/4 over base. So by exerting more control and influence, we get our borrowers better terms, we get them more success than they would otherwise have got in terms of getting the right outcome. So, in summary, it's a tough market. There are few sources of reliable and competent advice. The way banks make lending decisions is flawed, and borrowers need all the help they can get in navigating the bank's credit process. That's the presentation I put together today, but I'll leave you with one final thought. The market has changed. Banks are now not the only lenders. There are many, many, many different sources of finance, and actually that's a whole new presentation which we'll do on another day. But just to leave you with a thought, there are organisations called CDFIs, Community Development Finance Institutions. The local ones are Impetus, ART, Aston Reinvestment Trust, and BCRS, the Black Country Reinvestment Society. They all cover the whole of the West Midlands. They lend money when banks refuse. In fact, they can only lend when the banks refuse. They're more expensive, but they take more risk than the banks are prepared to take on board. And as I said, the price should reflect the risk. But they're not extortionate. They're still lending at reasonable rates to help small businesses. There are peer-to-peer lenders. There's lots of peer-to-peer lenders appearing on the market. Some want security, some are prepared to do unsecured, some will have bigger risk appetites than others. Again, their pricing is set by their perception of the risk. So banks aren't the only sources of money. And of course, if you can get a grant, then get free money first before you try to borrow. That's all I've got for today. Unless you've got some questions, thank you very much.
Great, thank you very much, Ian. That was a really interesting session. I'm sure you're going to get lots and lots of questions. Let's just have a look now on the system. Bear with me 1 second. Okay, your first question has come through from Simon, and he asks, why should I pay to get some help?
That's a good question. Why should you pay to get some help? There's a debate I've just been having with the client. In fact, I've just sent in the contract to sign because he's agreed he is going to pay to get some help. You will get a much greater chance of success at getting the facility you require than you will by doing it yourself. Yes, it's got a cost to it, and unless the deal is of a certain size that makes it cost effective, then it's worth paying to get some help. You will get a much greater chance of success, and as I said, the process we use is designed to make it as easy as possible for the banker to realise it is a deal they can do. We base our model on fairly simple psychology. Once we've got a banker to realise a deal can be done, then they want to do it. And because they want to do it, they will sharpen their pencils. I put a deal together for a client last year whose first comment to me when we sat down said, I don't know why you're here, I've already got an offer from my bank, you won't be able to beat it. His bank had quoted him 3.6 over base and a 1% fee for the money to buy his trading premises from his parents and to build a big extension. We had a long conversation. We eventually agreed a pricing structure that he was happy with, and he ended up with a deal at 2.45 over base and no arrangement fee. That saved him about £35,000. Actually, the deal I did with him was based on me getting a better deal than he'd already got, and he ended up paying me more than the fee I quoted him in the first place. But that's fine, we both won.
Brilliant. Next question is from Louise, and she asks, should I only apply to my own bank?
You should always apply to your own bank because that's where you've got a track record, but you shouldn't only apply to your own bank. You don't want to be stuck in a one-horse race. Always apply to at least two, have a fallback. I know it takes more time, and again, that's one of the advantages of having somebody do it for you. I spend the time talking to all the different banks, so you don't have to. You can get on with running your business, but don't rely on one, because I've seen deals been sat on a bank manager's desk for 6, 8, 10 weeks. The client thinks it's all being processed, and eventually they come back and say, yeah, I'm really sorry, we can't do this, and you've wasted 3 months. When actually they've just been sitting on it because they didn't know what to do with it and didn't want to say no right at the outset. So no news is not good news. No news means they're probably not doing anything with it. And just to put it into context how quickly they can react when they want to, I sent a deal out at 2 o'clock yesterday afternoon to 6 lenders. By 9 o'clock this morning, I'd got one flat decline, strangely from the client's own bank. This is the one with the large credit balances I discussed earlier. I got, yes, I can do this deal, it's within my discretion, it's all approved, these are my terms, from another lender. And another one came back and said, yeah, I like this, I know you've given us 10 days to turn it around, I'll come back with a full sanction rather than just indicative terms. So they can move quickly when they want to. If it's been several weeks, I'm willing to bet it's just sat on the too difficult pile and nobody's actually looking at it.
Okay, thank you. And you've got another question from John, and he says, the bank has said no, where can I go now?
Okay, well, you can try other banks. I've already mentioned CDFIs. They can only lend if the bank has said no. They require a letter from your bank that says the bank can't lend you the money before they can even look at it. That's the way they're set up. They're not allowed to deal with it if it's a bank approvable deal. So the CDFIs, there are lots of peer-to-peer lenders, but look around, look at the bigger picture. There may be other ways to structure the deal. I've mentioned a couple of times the deal at 1.75 over base. The bank that that client was with said no. They said they couldn't afford to buy the new factory. Actually, when we sat and looked at it, there was a different way to structure it using their pension fund and approaching it from a slightly different direction, and their customer could afford it. They could afford it very easily. So just because one bank said no doesn't mean all banks are saying no. It might mean you need to take a step back and look at how you're presenting it and what information you're giving them.
Okay, great. That's some great questions there. I'm sure there are many more. So I will be sending out a copy of Ian's full contact details out to you shortly this afternoon, plus a copy of his presentation.
And there's an ebook which I'll make available to you. You can send out as well.
Great, thank you very much. So thank you again, Ian, for hosting today's webinar. That's it from us this afternoon, but we hope you can join us again same time next Tuesday for our Lunch and Learn webinars.